Hey, welcome to the next video. How much down payment do you need to purchase a home? Now, this is going to depend on your situation, and there's many answers to this question. Okay, but let's start with what is a down payment? Okay, down payment is the amount of money paid up front when you're buying a home. A mortgage is typically used to finance the remainder of the purchase after or over a certain amount of time. Right, that's why we have the 30-year loans, fixed loans. There's also there's adjustable rate mortgages that are 5, 7, 10-year mortgages, but then that's for a short amount of time, but then they transition to a 30-year. So there's tons of different loans. You can also get a 15-year loan. Lots of different options for you. Talk to your lender, go through those options, okay? Just a quick example. So if the price of the home is $1 million and you put 20% down, that's $200,000, right? The remaining $800,000 would be the mortgage over whatever certain amount of time that you choose, the 30-year fixed, 15-year fixed, or if you go the ARMs, you have the 5-year ARM so you have 5 years at a certain rate, and then it's adjustable after that. It transitions into a 30-year, okay? And then down payment, it is separate from your closing costs, okay? So you have closing costs for the mortgage, you have closing costs. For the real estate purchase, you have closing costs, and you have your down payment. So you have all kinds of separate costs that are not a part of the down payment, okay? And these extra costs, these closing costs, there's a lot of variables that go into like how much it's going to cost you, right? So mortgage costs, you can actually bump your interest rate up a quarter point if you wanted to, or less, or just a certain amount, a little bit, and that will basically eliminate some of your closing costs on the mortgage side. Now on the real estate side, each one of those costs is negotiated in the purchase contract, right? So you have title escrow fees, you have transfer taxes. It's not a huge amount of money, but a lot of those costs are dependent, like transfer taxes is dependent on how much the purchase price is. So it's determined on that, okay? So those costs can be negotiated upfront with the seller, and they are variable. So you should kind of prepare for something around 3 to 6% of your purchase price. So whatever the purchase price is, take 3 to 6% of that, and that is the range of what your closing costs will be in order to purchase that house. Down payment plus closing costs. Okay, remember that. And before you close the loan, your lender is going to disclose this to you in what's called the closing disclosure. It'll present you all the fees that are associated with the loan, and you'll be able to break them down and see what those costs are and how much money it's going to be before you close on the loan, right? So if there's some discrepancies or anything, you can take care of that ahead of time, right? And then it's also the same thing on the real estate fees. The escrow department is going to send your realtor or you a document that says, here's all the fees associated with the purchase, purchase agreement, and we broke it down into this. Make sure it's right. Go through those costs. Make sure you're paying for your portion that you negotiated, and make sure those costs are good. Okay, and then you can often choose how much down payment you want to make, and it's completely dependent upon your personal and financial factors. Okay, so how much ever you put down is going to be dependent on you, and kind of also like what you qualify for, right? So how much down payment will you need? So first-time home buyers, you can put down as little as 3%. That is a first-time home buyer only program. So in order to be a first-time home buyer, you can't have owned a home in the last 3 years. So if you've bought a home before, but you sold it and you've been renting for a few years, you might be considered a first-time home buyer again. So pay attention. You could be putting down as little as 3% if you wanted to, right? Or if not, there's 5% programs there, and there's also FHA, which is 3.5%, VA and USDA. If you can find a USDA, they're a little difficult. They tend to be out away from the city a little bit, but those are 0% down. Those are the best loans you can get. Jumbo loans, you can put as little as 10% down, right? And conventional has the range of 3% all the way up to 25%. Now, one of the benefits of putting 20% down, it's the minimum that you need to put down in order to avoid mortgage insurance. Okay. And there's some benefits to that we'll go over later. So let's keep going though. So some first-time home buyer benefits, right? We talked about it. You can put as low as 3% down. That's very little. So you can get into a home almost right away, right? And there's state programs where even if you don't have, or if you have 3% but you don't have closing costs, or you have closing costs but not 3%, there are state programs that can help you. Down payment assistance programs. They're basically multiple loans that you will pay over the life of the loan. Okay, and you can always refinance out of those, and but you will have to pay off the down payment assistance loan, right? And there's also occupation specific loans. So police, fire, nurse, teachers, you guys do have some specific loans, and depending on where you're at and who you're helping, right? Teachers, if you're in a Title I school, you can get some down payment assistance that is a grant that you do not have to pay back. There are some certain requirements and things like that. So it is always beneficial to talk to the lender, tell them who you are, what your occupation is, go through that with them, ask for any special programs because there are some out there. And they fluctuate too. So you want to make sure that you're getting it when you can. And then tax breaks, right? You can write the interest on your mortgage, on your monthly mortgage payment. You can write that off at the end of the year in your taxes. And then also federally backed loans. We don't have prepayment penalties, so you can put more money down, right? If you take a 30-year loan, you can pay more towards your monthly, right? So you took a 30-year loan out, but you pay the minimum, and then you pay an additional halfway through the month, and that will go towards your principal. So talk to your lender, make sure you can set that up, and you can actually, even though you have a 30-year loan. You can sometimes pay that off in less time by just doing this additional payment halfway through the month. Okay, and then there's no loan calls, right? So they're not going to call your loan after 10 years. They're not going to be like, "Hey, you've had this loan long enough. Time to pay it off." They're not going to do that. No loan sharks out here. Your loans are federally backed, and there's no balloon payments. You don't have a balloon payment now. If you have a adjustable rate mortgage or an ARM, now that's not technically a balloon payment, but it can adjust, right? So if you have a 3-year ARM at 4%, but at the end of the 3 years, the 4 years, the average interest rate is 6%, that's going to jump up to 6%. And so you will have a different payment after that time frame. So just know that it's not technically a balloon, but it is going to adjust and your payment can change, okay? So what is a mortgage? A mortgage is a loan that's used to purchase the property, right? Remember, it's whatever's left after our down payment, right? And it's important because it allows the mortgagee, the person providing the loan, to take possession of the property if the mortgage is not paid on time, right? So it's important. We want to know what your mortgage is going to be, or what your pre-approval is, right? So talk to the lender and get your pre-approval before shopping for a home, right? The mortgage is vital, and it's important to determining what you can afford. Because sometimes you'll be looking at a property and you go through those mortgage calculators, right? They don't always take into account everything, and you'll be like, oh, I can afford a $500,000 loan. But when you go through it with the lender, you actually can only afford a $400,000 home, right? So we want to make sure that we get all of those variables accounted for, and make sure you're pre-approved before looking for the homes, right? Connect with the lender. Make sure you get pre-approved. You want to do this before you start shopping, so you know exactly what your budget is, right? And you can do this through a bank or through a mortgage broker. Right, they're going to require a number of documents, proof of income, credit bills, right? They're going to pull your credit. They're going to see what kind of credit you have, like car payments, credit cards, all those monthly payments that goes into your debt ratio, okay? And you can only get a certain amount of loan based on your debt ratio. We talked about that in the video previously, so if you want to go back, you can check that out. Anyway, they're going to take your down payment sources. Where are you getting your down payment from? Do you have that in a bank? Has it been in the bank for 3 months? Has it been sitting there? Is it mattress money? Because you can't use mattress money. You got to put it in a bank. It's got to be verified funds. Are you getting a gift from family? Has your family had that money in the bank for 3 months? Again, you can't use mattress money. It can't be you can't just hand the bank cash. It's not going to work that way. It's got to be certified and verified by being in the bank for a certain amount of time. Okay, usually it's about 3 months. And they're also going to check your credit score, employment history. And then they'll give you, the lender's going to give you your home buying budget, your interest rate, and your monthly payments. So that's also important, right? You want to know all of that before you go to purchase a home. What is my monthly going to be? What is my interest rate going to be? And what is my budget? What kind of house can I actually buy? And for the most part, with a pre-approval, you can lock your interest rate up to 60 days. Now, during the pandemic and the rate increases, and just recently through all that, they were not locked in for that long. They were only locked in for like 30 days. So talk with a lender, make sure you know how long that pre-approval rate lock is, and so that way you're always up to date. And the benefit of this is, so say the interest rate goes up, and you make a offer, you're not going to get that higher rate because you'll be locked in at what you were pre-approved for. So that's the benefit of that, right? And if it goes down, you're also going to win because they'll give you the lower rate. So either way, it's going to be a win for you. Don't wait, lock it in, and go from there, because you're just stopping it from going up. You can always benefit from it going down. And also remember, like, even though you get pre-approved, it does not obligate you to buy a home or get a mortgage. But at the same time, you don't want to be walking through your dream home, fall in love with it, and then later find out you can't get the mortgage, right? Or it's denied somehow. So get your pre-approval, get the lender to tell you what you can afford, but it does not obligate you in any way. It just sets you up for when you walk through that house and you find that dream home, that you can then go out and you can afford it. So here's some credit score check misconceptions. Many people have a misconception around credit checks when it comes to getting pre-approved, right? Banks and mortgages, they do have to pull your credit history. If you're gonna get a mortgage, they have to pull your credit. There's no way around it, right? If you decide, I want to buy this house, I'm getting this house, I want the mortgage, they're gonna pull your credit. No ifs, ands, or buts. You cannot get around it, okay? Because it's a key piece of information to determining your monthly budget. Okay, you're able to get an estimated buying budget without pulling your credit, but it's going to be estimated, and it's going to be kind of just based on information that you provide to the lender. Not all lenders like doing that, because it is going to vary wildly, right? You might not be telling them all the numbers, and they might give you a general price range, but then they find out when they pull your credit that you didn't tell them everything, and now you're pre-approved for something much less than what you went out and found. So it's always beneficial to actually do the credit pull, have the lender look at everything to really determine your budget. Yes, you can do it without getting that credit pull until you're absolutely ready, and you have to give the mortgage broker a heads up that you do not want them to pull your credit. But again, it's very open. There's no direct determination of what you can afford. It's just basic numbers, and you might not like it when they come back and say, actually, that was wrong. You didn't tell me about this, or we forgot about this, or did you know there was a missed payment, a year ago? And that really can change things for you. Okay. Now, there's different people you can get a mortgage from, right? You can get it from a bank, or you can get it from a mortgage broker. Okay. Banks are good if you have a bunch of money in the bank. If you are a member of Wells Fargo, for example, and you have a bunch of money running through them with car loans and money market accounts and stuff like that, and you're a high performer in their bank, then yeah, they're probably going to give you the best mortgage possible, lowest fees possible. But if you don't, and you just, you're the average buyer, you just have 3 to 5% to put down, the bank's not going to give you the best deal, right? So the best thing to do at that point is to go to a mortgage broker, because they will pull your credit one time and they'll be able to shop not only all the banks, but also separate lenders. And they can do that all at the same time with one credit pool, not multiples, and they can shop around for the best rates. Okay, let's talk about large versus small down payment. So there are some benefits to both, right? Large down payment, you can reduce the interest charges of your mortgage, right? Because now you're putting more down, so you have less financing, which is equal to less interest charges, right? Based on the amount that you owe. You can avoid mortgage insurance. So if you put 20% down or more, you won't have mortgage insurance premiums. So that's going to lower your monthly cost. So you lower your monthly payments that way, right? With a mortgage insurance, but you also lower your payment because you're taking out less. So it works both ways there. Easier to qualify for additional loans in the future. So if you already have a 20% down loan and you go to refinance later, your equity is considered in when you're getting the new mortgage, and you'll have lower fees and you'll be able to get a lower rate. And it's easier to have the home qualify for a new rate or whatever it is that you're trying to do for the new loan. And then you have higher equity, right? So you have more room to play. If you put 20% down, you can put more money into the house, or whatever. Your potential for equity gain is higher as the years go on. But lower down payment can also be beneficial too, because sometimes it can take a really long time to save up that 20%, right? For the example of the $1 million purchase price, right? Saving up $200,000 might take several years, and then you might be out of the range for what kind of house you thought you were going to be able to buy, right? So it can get you into the market sooner. It can get you buying a house sooner. And then it can also leave room for emergency savings, right? So technically, you might put 3% down, but really you have a bunch more in savings, and it can go towards emergency savings or maintenance or whatever. And then also, or it could go for renovations for the house. You buy a fixer-upper, you only want to put 5% down because you want to redo the entire kitchen or bathrooms or whatever, or all of it, right? You can do that with a smaller down payment and then refinance later down the road because of the potential equity gain that you've put in by renovating the property. And you can allow the market to carry you for the mortgage insurance possibly getting rid of, right? Or something like that, or just increasing your market, increasing your loan by going up with the renovations done, right? Okay, that's it for this one. Let's continue on to the next video.